Mainstream media has been confusing again for an average buyer. So if you talk to a real estate agent from, for example, Royal LePage, they still believe the market is still going to go up for another 10 to 15% this year. If you listen to any government official, they blame lack of supply. And if you talk to a short-term investor who hasn't seen a market correction in his lifetime, they will tell you that the market never collapses, it always goes up. Well, if you look at the history, it will tell you a different perspective, because if you study what happened in 1990, when Canada was pushed into a big recession which caused a big housing crisis, the market completely collapsed and it took almost 13 years to recover its original price. So in this video, I'm going to give you a quick history lesson to understand what happened in 1990s, what were the factors which actually caused the market collapse, and try to analyze what are the similarities between then and now, and can we see something like this happening in the near future. So without further ado, let's dive in. Welcome to my channel. My name is Yasin Nizami and I make this video to educate my audience about real estate market in Canada, some money matters in terms of how money works, how the banking system works, how this global financial system works, macroeconomics, and some technical sales. So if you are interested in any of these topics, consider subscribe, and let's get back to our topic of the day. One of the key reasons for 1990s recession was the higher inflation. Just like now, we're seeing the inflation print keep coming up every month. As per Stats Canada, yesterday's statistics, inflation print came out 6.7% in Canada. Although I don't believe these statistics, because the US is struggling with close to 9% inflation. How come we are sitting at 6.7 where we import a lot of stuff from US? But anyway, that was one of the main reasons of 90s recession. The other reason was the Gulf War happening in the Middle East, which pushed the oil prices up. Now, this is very important for Canadians to understand. The higher oil price is a double-edged sword. At one hand, it helps Canadian oil industry, because Canada is one of the major petroleum products exporter, but at the same time it strengthens the Canadian dollar against US dollar. Now if that happens, then it hurts our exports. It makes our exports expensive in the international market, and it makes our exports uncompetitive. Please keep in mind, whenever you see the Canadian dollar getting strength, it's not always good for economy. As a result of that, the inflation was keep rising in 1990s, and Bank of Canada had to increase the interest rate, because much of the inflation was monetary inflation, not the supply chain disruption as we are seeing now. So they raised the interest rate to something crazy like 14%. Although it brought the inflation down to a reasonable level, but it actually also crashed the entire economy. So when the interest rate reached 14%, you can imagine the money became so expensive, nobody's able to purchase car or house or even invest into business sector. So that has completely collapsed the economy. Unemployment went up to like 12%. It was a disaster, and started from 1985. I think it dragged on to like 1992, 93, and then from then onwards it started recovering it. That's what happened in Canada in the 90s recession, but it actually crashed the housing market. BMO did an analysis to create a home price index, and they tried to analyze what happened in 1990s and compare to what happened in the last 2 years. And you can see they find very similar trends, if they compare the home price index acceleration from 1990s to 2019 period, because the house prices were not cheap before pandemic anyway, right? It just added more fuel to the fire, because the interest rate was so low and people were moving out of town, so that added the fuel to the fire. So when you look at this chart, you can see there are similar patterns with regards to the home price acceleration, what happened in 1990s versus what we're seeing now. So that will tell you the trends are very similar to 1990s crash. So what you see here is the average home price chart, right? So the real estate crash occurred shortly after the prices in Toronto peaked in 1989. At the peak, the average sale through the Toronto Real Estate Board was $273,000. Over the next 7 years, the average price dropped and finally bottomed in 1996 at $198,000. If you have bought at the peak and sold at the bottom, you lost almost 75 grand, or roughly 27.6% of your purchase. It took 13 years for the average price to recover in Toronto. And if you adjust this with inflation, those 13 years become 22 years. To those people who believe the real estate never crashes, it always goes up, the history shows something very different. And you can see the steep rise of price is very similar to 1980s, what we are seeing right now. Nothing goes up vertically in a straight line. The price goes up and down like this. But if you see a steep rise of, price increase almost in vertical upward direction, you can expect some sort of a strong pullback anytime soon. And the environment right now is being ripe for this kind of a pullback, because when the Bank of Canada is pulling that stimulus out of the economy, which means not only they're increasing the interest rate very aggressively, we haven't seen that aggressive move since 1991, and they stopped buying government bonds, but also they're also selling the government bonds that they've purchased over the last 2 years. The worth of those bonds is around $350 billion. So imagine if that stimulus is pulled back, that will create a liquidity crisis. And when it happens, then the credit will have to be pulled back from the banks, because if banks do not have the capacity to issue more new loans, then of course there will be liquidity crisis. At the same time, the money that is already available in the market becomes so expensive because the rates are climbing up aggressively. This will most likely to have a major impact in terms of the demand for the housing, because imagine if the mortgage qualification becomes so difficult and the mortgage monthly payments become so expensive. This will wipe out a significant portion of the buyers from the market. And when it happens, what you can imagine, the demand that is out there is going to be significantly suppressed. And when the demand is suppressed, the prices will also go down. So that is the most likely scenario if the Bank of Canada continue pulling the stimulus out of the economy, at the same time raising the interest rate significantly. That will have a very, very likely scenario. If you're buying houses for your own self, to raise a family, to make this as your shelter, you should not be worrying about, because you're going to keep this house for long term, at least 10, 15, 20 years. But if you are an investor and you are only buying because you think the price will go up in the next 2 years and then you will make money, this is a very difficult times to make this kind of a bet. So please be careful. Do not make these financial decisions, because the market is not that healthy anymore, and there is a lot of chaos and liquidity crisis most likely to happen in the near time. So be careful with these moves, and time will tell. Again, this is just my analysis. Hope this is helpful. If you like it, give me a thumbs up and hit subscribe, and I'll see you in my next week video. Take care.